All good points. One of the things that you brought up a few minutes ago was replacement cost. What about replacement returns? So what I mean by that is you've got an asset that you've held, you've owned it at a great basis, and you promised investors perhaps a 3 to 5 year hold. You're coming up on that 5 years, and you're thinking to yourself as an investor, well, where else am I going to put this money? And perhaps, that's me from an LP perspective, you from the GP perspective. Obviously you want to deliver for your investors, and some of them may need liquidity, but I'll imagine that most of them are saying, hey, Rob, should we hold on to this thing for another 12 months and kind of reevaluate where we are? Is that something that BB Capital is perhaps anticipating as you guys start to get in that time frame of having to dispose of these specific assets?
Well, there's two sides to that, right? Is the market going to get better or worse from a institutional buyer perspective, or and that determines what you do. We do have a few assets that we are contemplating holding longer. To answer your question, just because the yield is so strong. Relative to what would happen right now. The shorter answer to what your question is, what developers can do is called a recapitalization. They can basically redo their capital stack with new money and allow people to either stay in or allow people an exit. And so they kind of redo their deal. And a lot of times this is done with a refinance. So maybe right now is not the best time, but that is something that's happened. We've done it before, and you may see more of that. Going forward, as some of these get longer, and then people decide, hey, our PPM that we offered you said we're going to exit in 5 years, but half our people don't want to exit. They've got to figure out a way to do that.
That makes perfect sense. One of the things you bring up, obviously, restructuring finance, and obviously right now, probably not the best time. I think a lot of GPs out there, specifically in the real estate space, would look to recap through refinancing their debt. And obviously with, that really isn't possible, or perhaps it is. I don't know where you're getting that debt from, but maybe there's a fairy out there that is giving you some incredible rates. But I haven't seen anything of late that would make me to believe that the rates would be better now or in the, near short term than they were 12, 24 months ago. I mean, that's obvious. But let me ask you this. I mean, there are a ton of real estate managers like yourselves out there. And I think the proliferation of, the crowd streets and the realty moguls, the yield streets out there, what do you think really separates BB Capital, not just in this environment, and please lead with that, but just overall the internal structure? How do you evaluate a manager other than looking at what their forecasted returns are?
Yeah, well, and you can't look at forecasts. You got to look at the track record, right? What I would tell you are the three shops that you just mentioned, they're not real estate developers. They're placement agents. And there's a big difference. A placement agent isn't going to go out of business if the deal goes south. Right? Their own money's not at stake. If you're a placement agent, that deal goes south, sorry, next deal, that's what happens. If you're the developer, you're the issuer, like Tom knows this, right? If that doesn't work out, then not only did you lose a lot of money, you got the reputational risk that you can't afford to have. I tell people, one bad deal, you're done. You just can't afford to have that happen. So who you're working with and how directly you are to the action is super important, especially today.
So what else specifically, because obviously you're right. I mean, they act as a broker dealer. There's some criteria that these firms obviously go through to get, to find the deals, right? I mean, there is a checklist and some due diligence, and obviously they don't necessarily feel the effects if there's a dog in there, right? I mean, so the interests perhaps aren't aligned. I certainly love what they are doing in democratizing real estate investments for the average investor. I do like that. And I think it can be helpful. But one of the things it also does is, we talked about this a little bit before, is that it creates perhaps a crowded trade. And now with these crowded trades, you've got a lot of unskilled or less skilled fund managers coming into the marketplace that perhaps could, be detrimental to the overall business, right? You think of everything about the public market world, and, when any of these scandals has happened, they affect everyone. It's almost kind of like that bad apple rule in our old world, right?
Yeah, Mitch, Rob, let me ask you this. So are you primarily positioning your deals in the urban core? Are you on the fringe? Where are most of your deals placed?
You couldn't even categorize us.
Okay. So yeah, because I'm curious, because what I'm seeing, because ours are kind of on the peripheral of the MSA. I've seen debt's still flowing, equity's mostly still flowing. The one question mark I get a lot now, a little more hesitation, is we prefer for you to be closer to the urban core given the markets. They're a little more hesitant to be on the outside. Are you seeing that same sort of hesitation, or what are you seeing from the investors or the debts?
Well, keep in mind, we've already locked in all of our debt on everything we own. So it's probably not the best time for me to answer that question, Tom. So we're not necessarily seeing
That's
that.
fair.
We've got stuff that is literally in the urban core, and then we've got stuff that's considerably far out and even considered vacation. So, it's just, once again, when you're doing construction or land development, the margins are so good that you can afford a little higher rate in the short term. So it hasn't really touched us per se. That's a harder one for me to really answer, because everything's locked in already for us.
Got them on one, Mitch. I got them on one.
Rob, it's always great to have you on and give us some insight. Anything specific you'd love to share with perhaps might be coming without getting too specific from BV Capital in the short term?
Yeah, we still have ground up. We're still chasing land. We're going to take land down with our investors, and then we're going to finance the construction by donating the land to the deal. That's one way we get financing done, Tom. So we own our land debt free, and then we have a lot of construction deals we probably have 6 or 7 that we might launch within the next 6 to 9 months. Just to give you an idea, we're staffing up our construction company right now.
You poor soul.
Yeah, we gotta get some easier access to labor. There's no question about that. So,
what? One thing I was going to tell you, Mitch, you were talking about just a crowded marketplace. I didn't really answer this. You're seeing retrades happen. You're seeing some deals fall apart. You're seeing deals fall out. There are people that had either existing properties or land under contract, and they can't get the financing they're wanting. To Tom's point, maybe it didn't meet the metrics that people are asking right now. And we're finding a lot of those because a shop like ours can go get those, and we can help salvage that for somebody. That's creating opportunity. So I'm actually going to say I think we're going to have a less crowded marketplace the more this continues.
I agree with you. Well, man, thank you so much. Go feel better. By the way, if you didn't tell me you had the sniffles, I would have never known. So thanks again, my friend.
Thanks for having me, guys.
Yep.
Take care, Rob. Tom, really interesting stuff coming from Rob as always. And you look at kind of the ground up multifamily space and ground up development overall in general. I think that kind of shares some similar sentiment to some of the same thoughts that you've got at Red Oak on the single family side.
Yeah, I mean, I think if I were selling my lots and my stuff right now, I'd be in a tricky spot. Builders are definitely doing slower takedown schedules. Most of the guys I talk to, the DR Hortons, Lennar, Century, Braun, they're thinking 2024, 2025. These next 12 to 18 months is kind of a moot point. They're going to slow down. They're going to renegotiate where developers were aggressive. We have our 7 scenario underwriting. If we hit our high, we don't feel the need to go any higher than that on negotiations. Well, we, I guess, underprice ourselves. However, the good news is no one's backing out of our deals. So,
Tom, what is this 7 scenario that you just mentioned? I'm interested in this.
Yeah, I've OCD to the max. And I'm so afraid to lose money. That again, it's a standard sensitivity analysis on low, mid, high. We then have a crash scenario of a 20% devaluation in the land, everything else. And then our seventh scenario is if we can't get financing on the horizontal, then we have to do it as just papered lots, right? So every scenario has to make money. Our crash scenario has to make an 8% margin or above. Our target margin's around 25-30%. So if we're hitting all those metrics, and when I go to market, and I shouldn't be telling this because here's my strategy. I negotiate my high scenario with the builders first, and I know it's viable all the way down the low. Well, when it was hot and heavy, we were getting no pushback on the high scenarios, which tells me I left a lot of meat on the bone. But right now, it's to our advantage because no one's backing out because our prices are the best. And by the way, a lot of these builders have been told by their corporate headquarters in Denver or New York, or wherever it is, no more self-dev. You're going to buy lots from developers, entitled or developed. Well, newsflash, there's not many of us, right? So it's good news for us in a market where the lot supply is crashing. So, and again, going back to what Rob's point, I think supply is going to be tough coming out of this in 12, 18 months.
Tom, do you see being able to sell paper lots to the developers, or are they backing out from that entirely?
No, I mean, so I don't have any paper lot deals. I've always assumed we had to go full ham, right, all the way through. But they're shifting because 85% of their book is their own self-div. Well, they still have quotas. They're publicly traded companies.
Right.
So they have to pivot, and they're willing to take on entitled lots.
We've seen that. That's why I asked. I was curious if you're seeing that.
Yeah,
too.
there's definitely an uptick for sure.
Tom, you brought up an interesting point because one of the deals I remember that you structured 12 months ago that I had a hand in bringing one of the builders to the table. We talked about pricing per lot, and perhaps you could have got more. And had you gotten more, maybe they would have had a little buyer's remorse today, where they perhaps may have been forced to back out just because the economics and numbers just don't work. Have you seen any of the home builders that you're doing business with? Have you seen them at all have any inclinations of doubt or talk to me? Are they thinking about pulling out?
Look, if you look at the numbers, Lennar took the first bite, right? They've seen some pushback on their positions. DR came next. So you're seeing some drop off from DR for sure. Century's feeling a little bit of pinch right now. These are all the move up or entry level builders, right? You talk to Toll Brothers, the Drees, the Weston, GFOs. I mean, yeah, they're seeing lower traffic, but they're doing fine as well. Their margins are still very strong.
Their stock stinks.
Well, hey, if I weren't a believer in putting my money elsewhere, aside from my main wheelhouse, I would probably invest in some of them. Their margins on the accessories and the upgrades are like 45 to 50, like 48%. I mean, it's massive for those doors and cabinets and wine cellars. That's where they make all their money. They're making roughly 20% on the home or 25% collectively. So the home itself as a spec is not the most rewarding, monetary, piece of it. It's really all those little features you add on. The $2,000 fan that's hanging above my head that my partner had to have, that's where they make all their money.
That's true. It's all in the little stuff that starts to add up. Well, hey, a great session. And Rob, thanks for sticking around. We said goodbye to Rob and he's just still hanging around. And I'm glad you asked that question because it was definitely thoughtful. And as always, it's good to see you, Tom. Appreciate the insight. Thank you, Rob. Again, until next time, we'll see you.
Thanks, team.